Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Daybreak Weekend, our global look ahead at the top stories in the coming week from our Daybreak anchors all around the world. Straight ahead on the program, a look at some key inflation data in the U.S., what it could mean for Fed policy moving forward. Plus, a look at earnings from the computer software giant Oracle. I'm Tom Busby in New York.
I'm Caroline Hepker in London, where we're following Europe's central bank as it navigates an unprecedented time in the region.
I'm Paul Allen in Sydney, looking at next week's RBA decision and Australia's social media ban for teens.
That's all straight ahead on Bloomberg Daybreak Weekend. On Bloomberg 1130 New York, Bloomberg 99.1 Washington, D.C., Bloomberg 92.9 Boston, DAB Digital Radio London, Sirius XM 121, and around the world on BloombergRadio.com and the Bloomberg Business app.
Good day to you. I'm Tom Busby, and we begin today's program with a look at some key inflation data on the heels of a big bounce back in U.S. job creation last month. November's Consumer Price Index out on Wednesday, 8:30 a.m. Wall Street time. The Producer Price Index for last month comes one day later. For more on what to expect, we're joined by Edward Harrison, author of Bloomberg's Everything Risk newsletter. Edward, thank you so much for being here.
Good to talk to you, Tom.
Well, now inflation has come a long way down over the past 2 years, still has a long way to go before hitting the Fed's long-established target of 2%. So what are you expecting to see in October's CPI number?
This week, we're expecting to see the year-over-year number for CPI tick up ever so slightly to 2.7% from 2.6%. And when you look at the core number, taking out food and energy, the expectation is it's going to be roughly the same as it was last month, which is 3.3%. Both of those are based on 0.3% rises on a monthly basis. Now, obviously, 2.6% going up to 2.7 and 3.3 are not that great numbers, but it's still coming down enough that I expect that the Fed will still cut interest rates in December if the data come out as expected.
Wow. Only about half of Wall Street thinks is with you on that one, but there is a lot of hope. Well, let's talk more about those numbers and what's behind this stubbornly high inflation, because as you said, 2.7% year over year overall. It's good. It's not great. So what are the big factors that are keeping inflation so high?
Well, it's definitely not food and energy, right? Because if without food and energy, you're at 3.3%. Versus 2.7% a year on year with food and energy. Really, it's about, core services and housing in particular. Those are the things that are still, sticky and, sticky at a level of over 3%. And so what that means is that as 2025 develops, the cuts that we've been seeing at every single meeting by the Fed are going to come to an end. In about a week's time, the week after this, we're going to see the Fed's dot plot. And in that, it's going to tell us what they expect, how many rate cuts that they expect. The market is now pricing in actually about 3 rate cuts for 2025. So let's just see what the Fed says when they come out with their data a week from now.
Yeah, that's a biggie. This is a meeting December 17th, 18th. The big decision, to either hold steady or, as you expect, another 0.25%, 25 basis point cut. Is that what you're thinking?
Yeah, and that's pretty much in line with the market. We can talk a little bit about the jobs numbers that we saw last week, but on the basis of the jobs numbers, immediately after the jobs numbers came out, the swaps market, which shows what the market is expecting the Fed to do, went from 60% odds of a cut to over 80% odds of a cut. So this number, the CPI number, this is going to be the one that either solidifies it or makes it a little bit murky. But we're at 80%, so that says that likely we're going to move towards 85, 90% if the number is in line with expectations.
Wow, so that jobs report really did a number, you think, for the Fed. Well, let's talk about it. 227,000 jobs added. It looks like maybe we've exorcised the ghost of those devastating strikes, a couple of really bad hurricanes. I mean, is this, hey, we're back in business now after that dismal October number?
Well, it does seem that way to me. The number, the 227 number, comes with 56,000 of net revision upward from the last 2 months before that, and now we're at about 170 some thousand a month over the last 3 months. That's up by 50,000. So you might think that those numbers would make the market spooked, but actually it wasn't, because if you look at the household survey, the unemployment rate went up. So the unemployment rate went up from 4.1 to 4.2%. And if you've listened to what these Fed speakers are saying, Chris Waller is one that I was thinking about. Another one is the Atlanta Fed's Raphael Bostic. They're basically saying, unless the data are really terrible, we want to have a preventive cut going forward. Same thing from Austin Goolsbee of the Chicago Fed. They're all saying that, this meeting, yes, we're going to give the cut, the market's priced it in, but then going forward, we're going to be a little more circumspect.
So 3 rate cuts in a row to end 2024, you're thinking, but 2025 definitely dialing back on that more aggressive rate cut strategy.
Exactly. And, a lot of this, remember, is about the real interest rate. That is that as inflation comes down, the Fed is saying, unless we bring rates down, then it's going to be restrictive, not necessarily for those companies that can go out and borrow money in the capital markets, but for small businesses that are getting their loans based upon these rates. We really need to bring them down in order to be less restrictive for those companies.
Well, November CPI data out this coming Wednesday, PPI on Thursday. And our thanks to Edward Harrison. He's the author of Bloomberg's Everything Risk newsletter. We turn now to earnings from one of the biggest names in technology, software giant Oracle, putting out its Q2 results on Monday. Will the artificial intelligence boom continue to fuel Oracle's year-long rally? And for more, we're joined by Anurag Rana, Bloomberg Intelligence technology analyst. Anurag, thank you so much for joining us. Shares of Oracle have skyrocketed this year, mostly on its cloud infrastructure services. So what do you expect to see in this earnings report on Monday?
Yeah, I think we'll listen to more of the same, in a sense that cloud infrastructure revenue should continue to go up. The question is going to be by how much, and whether the revenue recognition is being held back by the shortage of supply, which is the GPUs that are sold by NVIDIA, whether they're able to get their hands and do enough of them. So when you look at somebody like an Oracle, it has a massive backlog right now. And we'll get to that in a second, how it has that big backlog. But the problem a lot of these cloud infrastructure providers are facing is their data center capacity, as well as their hardware capacity, is still a bottleneck, which is people are sending work for them, but they're not able to fulfill that demand. And that's where Oracle also is at this point.
So a shortage of GPUs, stressed data centers, but Oracle has built more data centers, hasn't it? Including plans for a nuclear-powered one. It is just go, go, go for them. Are they keeping up? Are they going to meet demand?
See, the thing is, it's unlike just buying GPUs, which is also in a shortage. Data centers take time. You just can't spin up a data center overnight. It takes a few years to build one. What companies are doing right now is taking their old data centers and retrofitting them with new equipment, new cooling technology, new GPUs, new hardware, in order to run some of these workloads. But in order to create a new one, that takes time. And actually, that's what's benefiting Oracle in one way, because Microsoft has this relationship with OpenAI, and OpenAI is sending more and more workloads to Microsoft's cloud product, which is called Azure. And Microsoft is seeing that shortage. So guess what it's doing? It's tapping into Oracle and saying, hey, can you be my subcontractor and I can lease into your data center and run some of the workloads over there? And that's really, Oracle's laughing about it because it's having to service, it's one of its bigger competitors and partners. So it's getting a lot of work from Microsoft also at this point. So that is the big story for Oracle, and we think it is going to be the big thing for at least the next couple of years.
Well, Oracle, not only Microsoft, it also had deals with Google, and just a few months ago, a big deal with Amazon Web Services was announced, correct? Yeah.
Exactly, yeah.
Tell me about all those deals.
It is the same deal, basically. What it is saying is if you get a command or a workload and you don't have capacity to do it, send it my way. I will be your subcontractor and you can run it in my data center and you will pay me for it. So it's a good thing for Oracle that it has this capacity, it has this data center. And as I said, in principle, the only thing that's holding back all of them is that there's a shortage of GPUs and the processing capacity. There is another thing that's helping Oracle, frankly. I talked about one thing as an outsourced for the three companies that we mentioned, but there is another element that a lot of startups are also going to Oracle and saying, you know what, I just want to go out and experiment on this cloud infrastructure. And Oracle is giving them a good deal, giving them, because remember, from a market size point of view, Oracle's cloud infrastructure is fourth in size. The biggest one is Amazon, then Microsoft, then Google, and Oracle, given its large wallet, if we can fund several $billions of capital expenditures, is now, in our view, the fourth biggest cloud data center company.
But is the cloud data center becoming more, not just the management, what it used to be, becoming more of the cash cow for Oracle?
Yeah, it is. Oh, no, it's growing very well. It's growing somewhere north of 40%. I think consensus has that product to grow by 50% this particular quarter. That's going to be on Monday. So from a revenue point of view, they are gaining as much market share as possible. Whether they are making enough money, that's okay for them because it's okay to buy it at a cheaper price or taking even if a bit loss on that end, only because they have some other products that are highly profitable. Their old business of core database is very profitable. They have other applications, cloud applications on HR, customer service management. They are very profitable. So it is really one of the most profitable software companies out there. So it's okay for them to lose a little bit money on the infrastructure as a service. I don't think they lose money there because since those financials are not publicly available, even if they make less money on that compared to the database, that doesn't matter because in totality, it's adding to the overall revenue base of the company.
Well, a lot to watch for. Q2 results from Oracle out on Monday. Our thanks to Anurag Rana, Bloomberg Intelligence technology analyst. And coming up on Bloomberg Daybreak Weekend, we'll look ahead to Europe's central bank decision as it navigates an unprecedented time in the region. I'm Tom Busby, and this is Bloomberg. This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Tom Busby in New York. Up later in our program, we look ahead to an important policy decision from the Reserve Bank of Australia. But first, Europe's policymakers convening this week to make their last interest rate decision of 2025. That's against a backdrop dominated by political uncertainty. Amid governmental challenges in France and looming U.S. tariffs, could the rate path ahead be more slippery than first anticipated? Well, for more, let's go to London and bring in Bloomberg Daybreak Europe anchor Caroline Hepker.
Tom, the European Central Bank is likely to cut interest rates again at its December meeting. Policymakers may debate a bigger than usual move, but comments from individuals suggest that they will proceed with caution for now. Speaking during a recent television interview, the Bank of Latvia Governor Martins Kazaks said that uncertainty is still very high, with a number of complex geopolitical risks facing Europe. Governing Council member Joachim Nagel has suggested interest rates should converge only slowly towards neutral territory. So support for a 50 basis point move does seem limited. Layer onto that the political crisis in France, one of the bloc's biggest members, after Michel Barnier became the shortest serving prime minister in French history. His government collapsed following a vote of no confidence, crucially before a budget could be agreed in Parliament. The fiscal unpredictability of Europe is something ECB policymakers will have to consider at their upcoming meeting. Bloomberg's Stephen Carroll and I discussed this with Maria de Mertzis, who is programme leader at the Conference Board and professor of economic policy at the European University Institute.
Well, I mean, the first thing is that we need to understand who will govern France. And the issue is that President Macron is not allowed constitutionally to call elections again, given that he's called elections back in June. So that means that for 1 year, since last June, that means, till next June, we will have to have a technocratic government, another prime minister, or a technocratic government that actually does the government business, right? And that means that we will have to operate with the current budget. And political decisions will not be difficult. Political decisions will not be made. So I think that is what I foresee till next June, when President Macron will have the chance again to call elections.
Italy may be used to having a technocratic government. France certainly is not, and the budget deficit is the main challenge. It is expected to run at 6.1% this year. How significant an issue is this going to be for Europe to have this continued uncertainty and instability in France?
Indeed, it's not good. And in fact, the reason why we are in this position here is indeed because Prime Minister Barnier was trying to put a budget forward that was going to take us back in the right direction and in compliance with the European rules that have come into operation since September. All of this is postponed now. We'll have to wait for the next French government to actually do the job. But it will have to be done, and the European Commission will be watching very closely. I remind you that France is under the excessive deficit procedure, which is the corrective arm of the monitoring process of the European Union, and that means that the European Commission will be watching very carefully.
What happens with the EU Commission's reaction to this if we do end up in this situation where they're rerunning the current budget, which means the deficit is going to be far above what had been submitted and approved by the Commission in the pre-budget rules? I mean, what are the next steps that the Commission can take if they're on this temporary holding pattern for the next potentially 6 months?
Progressively, it can put, of course, enormous pressure on whatever French government is in place to actually do the job. In principle, it could also impose fines on the country. In practice, this has never happened. And I don't think it will happen, given also what we call the French exceptionalism. But I think the pressure for France to deliver is going to augment, and it's going to come also from other countries, because there's good reasons why we have fiscal rules in the European Union. And if a country like France, which is big, actually violates the rules, this isn't good, either for the history of the rules or indeed for the European economy.
The conference board keeps close tabs on the views of CEOs within Europe, looking at the stock market as a measure there. Obviously, European stocks, particularly French equities, have been suffering. But we've seen a bit of a bounce in recent days, and Germany's DAX has done actually reasonably well year to date this year, which seems quite strange given the pessimism that CEOs do have on European economic growth.
Indeed, the CEOs actually tell us that they're in a recent survey that we've done, they tell us that they actually prefer to operate outside Europe because I think European economic conditions in Europe are very favourable. It's consistent also with the current account numbers that we see. Business conditions in Europe, they could be improved, and this is exactly what Draghi, of course, the mission of Draghi was very much to find the policies that we need to put in place for this to change.
Is there actually any political currency, though, to implement any of those recommendations? I mean, we saw the Commission point to the Draghi report and the other reports that have been done on competitiveness in the European Union as well. But realistically, if the national capitals aren't kind of up there and pushing it, and particularly France and Germany, nothing's really going to get done, is it?
It is true that we need France and Germany to act as a Germany, as in a coalition of change. We need them, and with both actually countries now in political instability, things won't move very fast. However, what I will say is that the CEOs are telling us that if there's one change that they want happen is simplification of the regulation. This is actually the top number one priority that they tell us is this. And what we saw actually, the European Commission has actually put the point in the agenda very high in the priorities. So I would be very curious to see how they aim to implement this.
Yeah, I mean, I suppose speed is also the other question involved in this as well, as how fast they'd be able to do something. I wonder, does something like the 28th regime, this idea of creating a separate corporate structure that could operate across member states, I mean, that's the sort of idea does that get CEOs excited? Is that a policy they could get on board with?
Yes, but like I say, I mean, the CEOs understand how slowly Europe moves. The 28th regime is an idea that has been around for a very long time, particularly with regards to the creation of the Capital Markets Union. We've made very little progress in this respect. I think CEOs want tangible change, and this type of change, this simplification of regulation, is something that can in principle happen happen. It doesn't require money. It doesn't require much agreement. Of course, it does require parliamentary approval. But everybody agrees on this. So I think this is one of the low-hanging fruits, that if we get ourselves to implement it, we can actually make change, yeah.
My thanks to Maria de Mertzis, who is Programme Leader at the Conference Board and Professor of Economic Policy at the European University Institute, someone who spends time in both Brussels and Florence. So after the failure of Barnier's administration, which injects uncertainty and perhaps more austerity into France, how will the ECB choose to rebuild? Is something I asked Bloomberg's senior reporter covering the central bank, Jana Randau.
I think France in itself is another source of uncertainty, of course, and there are already plenty other sources out there, and I'm sure we will get a chance to talk about that. When it comes to the decision itself in the coming days, that of course will not be affected by what we're seeing in France. But of course, the economic outlook very much will. Both the French economy, which of course is the Eurozone's second largest, and the Eurozone economy itself, they're not doing very well at the moment. PMIs are deep in contractionary territory, and uncertainty of this caliber weighs on consumption. It weighs on investment. It stands in the way of reforms. The absence of a government in France, of course, means fiscal policy is very much a wild card. And also an important voice is missing at the European level. So a lot more uncertainty to in the future to be aware of that will change the way the ECB looks at the economy and the economic outlook and the risks associated to that outlook, but not much of an impact on the decision itself, I would say.
Yeah, OK, but the possibility of an economic drag perhaps further down the road. So in terms of this upcoming meeting, do we expect 25 basis points or could we see a 50 basis point rate reduction?
Yeah, I think 25 is what I would bet my money on. 50, it's been talked about, if you ask me, was never a real option. It was part of the speculation that the ECB might go down this route after PMIs were significantly weaker than expected, after inflation didn't pick up as strongly as people might have expected, but even the market has come around to pricing no, or not significantly more than a quarter point cut for Thursday's meeting. So I would say 25 is the way, the way to position.
Yeah. In terms of the risks, though, in Europe, there are a number, aren't there? Not just the geopolitical uncertainty in Ukraine. There's also Georgia and looming, possibly, tariffs from an incoming Trump administration. How will these factor into the interest rate decision process? So many risks.
So many risks indeed, and all of that makes it very difficult to know what's ahead. We'll get new forecasts, which is going to be very exciting. We'll get a chance to look all the way into 2027, but of course, that's a set of forecasts built on assumptions. We don't know yet what's going to come on the tariff front. We don't know how the war in Ukraine is going to pan out, which will have an impact on how Europe deals with its own defense. It might impact energy, overall uncertainty, of course. So the risks and the uncertainty around those forecasts are just enormous, which makes it very, very difficult for policymakers to say with certainty what's needed, where to go, and that's a big part behind why policymakers say we are data dependent. We take a very gradual approach here. We're going step by step, and then we look around and see how our actions, our policy affect what's actually happening in the economy.
Mm-hmm. In terms of the data, as you say, the pressures on the economy, the possibility of stagnation really across Europe is quite significant. The pressures on inflation, though, have also been coming down. Just talk us through the inflation picture now for Europe.
We have seen a small pickup in headline inflation that was very much in line with, expectations. So that was not a big surprise there. the surprise really was underneath the headline number. So we had core inflation holding steady at 2.7%. It's obviously still above that 2% target, but it was weaker than expected. We are seeing a slowdown in services prices finally from a very high level. Of course, we're still closer to 4% than 2% on that indicator, but we're seeing movement as well. And what is going to be very interesting on the inflation side is a look at the quarterly profile of the new projections I mentioned, and that will tell us, something about how confident they will be in cutting interest rates further.
My thanks to Bloomberg's Jana Randau, and we will have full coverage of that final ECB meeting of the year with a Bloomberg survey showing that ECB watchers now expect the central bank to cut a quarter point at every policy meeting through to June, taking the deposit rate at the ECB to 2%. I'm Caroline Hepker here in London, and you can catch us every weekday morning for Bloomberg Daybreak Europe beginning at 6 a.m. in London. That's 1 a.m. on Wall Street. Tom.
Thank you, Caroline. And coming up on Bloomberg Daybreak Weekend, we'll discuss Australia's social media ban for teenagers. I'm Tom Busby, and this is Bloomberg. This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Tom Busby in New York. Australia's household spending rose 0.8% in October, exceeding estimates. This as the Reserve Bank of Australia is set to issue a policy decision this week. Bloomberg's Paul Allen is in for Doug Krisner on the Daybreak Asia podcast, and he has more from Sydney.
Tom, the pickup in Australia's October retail sales reflects a boost to household spending capacity. The data probably gives the RBA more room to hold rates for the time being, while it waits for inflation to cool. And that's according to James McIntyre, who covers Australia and New Zealand for Bloomberg Economics, and he joins me now in our Sydney radio studio. So, James, it's been more than a year now. The next move from the RBA is likely to be down, but when?
So 12 months, that's one of the longer holds that they've had. We have been thinking that they should be cutting already, but we've been wrong on that. And why we've been wrong is we've been surprised by how strong population growth is and adding that extra demand to the economy. It looks like that's phasing off. So the question is there going to be enough evidence in the first quarter of the year for the RBA to begin cutting in February or March? My view is that we'll at least be seeing that first move by May. So it's a question this year of whether there is, kind of 75 or maybe at a stretch 100 basis points of cuts from the RBA next year. At the moment, the data is pretty strong. It's looking like we might be on that May start.
You're not the only one who thinks that the RBA probably should have gone by now. We had some commentary from Goldman Sachs saying that the RBA's no longer got an argument to keep rates high, and continuing to keep them high is going to inflict unnecessary economic damage. Now, the RBA was slow to tighten and it got criticised for that. Now it's slow to ease. Are we seeing the formation, the genesis of another policy mistake here?
Well, I guess we need to kind of look at what are they trying to achieve and why would they cut? And I think it's really the labour market that's been the surprise. If we hadn't had that population surge, we would have had a lot less demand in the economy, taking a lot more wind out of the pricing pressure, especially with demand in the retail sector and the like with that. But that demand being there in the economy has meant that labour market's been there, and it's been quite strong as well. And we'd been expecting the unemployment rate to be, marching well towards 5% by this time, giving the RBA a clear-cut reason to lower rates. But at 4.1%, that's what the RBA's clinging to, but that very narrow path. And this has been the rhetoric from the RBA, wanting to maintain those labour market gains, staying on the narrow path, keeping that unemployment rate down. It's very, very dicey about how long you hold, because you can overcorrect. And we're seeing that in New Zealand, and the repercussions of that in Australia, interestingly, is that with that New Zealand labour market being so terrible, Kiwis have started flooding across the border here to Australia, and adding to the RBA's delay and problems.
And of course, there's no restrictions on the number of New Zealanders that can come over either, thanks to the closer economic relations agreement. But immigration's a really important part of the story here, and it impacts the property story as well. And I want to get to that in a minute. But the other part of the dual mandate is, of course, inflation. Now, it's coming down. Is there a risk of undershooting here?
Well, look, in my view, yes. That's where the balance of risks lies. So the RBA is still, the underlying inflation has been coming down. It's a little bit slower than the headline inflation. Some of the reasons that are, there is this embedded stickiness. Every country's got little different quirks with their inflation, and some of the Australian story at the moment is a bunch of these administered prices, and some of them are basically goods that go up by inflation the year before. So we've got a bit of an echo in some of the inflation right now. And that low inflation that we're getting as a result of the government's steps to provide cost of living subsidies and really putting downward pressure on the headline inflation, those are things that will be anchored pretty low next year, but we could see that undershoot. All of that would be a recipe for things going a little bit more south, a little bit quicker than the RBA is expecting, and pulling inflation down with it. That's where that balance of risk lies, in my view.
Growth's really been struggling, hasn't it? I think Jim Chalmers, the Treasurer, said in the second quarter it was only government spending that kept the country out of recession. How great is recession risk?
Yeah, well, I mean, if you look in per capita terms, we've been in recession for more than 18 months, and that's likely to continue in the GDP figures that we'll see for the third quarter. And it's unlikely, I think, that we do see that per capita GDP growth actually beginning to pull up until that's unlikely until we get rate cuts helping to kind of relieve some of the tension on consumers there. So yeah, it's a very dicey outcome, very low growth, very weak growth, which means that the labour market outcomes that we're getting, some of those are reflecting previous growth in the labour market ahead. The outlook isn't as strong. And I think that's that very, very delicate balance, that narrow path that the RBA is trying to thread here.
James, we'll just finish up on the property story because it is the great Australian barbecue stopper, if you like, and so rate sensitive as well. And we've seen property prices cooling in Australia, and that's a relative term. I mean, we're still in nosebleed territory here. But once the easing cycle does begin from the RBA, are we going to just see prices reigniting?
Well, it's really a tale of two stories within the property market. The Melbourne property market's been very weak for quite some time now. Sydney's starting to show those signs of weakness, especially at the top end, and that's where the borrowing capacity hit from high rates is really leaving its mark. Those markets are likely to be ones where you could see quite a bit of upside if we do get a strong rates downward rate cycle. But 50, 75 or 100 basis points over the year, it's not going to give you that bigger punch on borrowing capacity and property price boost as other rate cut cycles might have. So I think we might be relying on sentiment in those two biggest cities, which are the most important ones for the Australian economy. A bit of a sentiment improvement as rate cuts maybe helping propel things a bit next year.
All right, thanks, James. As the RBA keeps us waiting, that is James McIntyre, who covers Australia for Bloomberg Economics. We move next to Australia's sweeping social media ban. Last week, Canberra passed a law banning teens under 16 from platforms like Facebook and TikTok. It marks one of the toughest crackdowns on these social media companies, and the move is sending shockwaves through the industry worldwide. Bloomberg's Angus Whitley joins me now for a deeper dive. So, Angus, key among this new law is parents aren't going to be responsible for enforcing this ban. It's going to be up to social media companies to do it, at risk of a $32 million US fine for non-compliance. How is this even going to work? I mean, can't kids just find a way to get around this?
I think this is one of the big unanswered questions sort of hanging over this legislation. You're right in that the law really does put the responsibility on the social platform operators rather than the kids and even their parents. So it's the operators like Facebook and Snapchat that must find a way somehow to check the identity or the age rather of their users without some kind of formal government identification, because that has also been ruled out. So one of the weaknesses, if you like, when this law was passed is that this technology doesn't really seem to exist in any practical form yet, at least. Yes, it's true that the law does not come into sort of effect for another 12 months or so, but even then it's not quite clear whether the technology will be in place even then. So, yeah, how are the kids going to be checked? There are privacy concerns there, facial recognition, perhaps, that doesn't seem to be up to speed yet. So, yes, that is one of the questions.
Yeah, I've seen other commentary around this suggesting that, even things like browsing history, online shopping behavior, whether or not people have a MyGov account, these are all ways that social media companies can detect whether or not a user is likely to be of age. But it doesn't really draw that definitive line in the sand, does it? What are social media companies saying about this?
As you'd expect, there has been a strong wave of opposition to this legislation. I mean, this is a key demographic, isn't it, for social media platforms? Teenagers, youths, they may not be spenders at that age, but they mature into valuable customers, don't they? So they want to get their teeth into these users, as it were. Having said that, they do make some criticisms which do appear to hold some water. That they argue that the law is sort of ignores the practical side of age verification technology, which you could argue is true. It's been rushed, they say, which is also true. I mean, it was ploughed through the Parliament in a matter of days. Very little time for consultation, the platform operators argue, and very little time for a Senate inquiry as well. Indeed, it didn't even have time, it seems, to publish all the submissions it had on this legislation. A lot of that is driven by the terrible toll that social media inarguably takes.
This has come about because of some of the very sad stories out there.
That's right. These are profoundly sad stories. Users, teenagers, taking their own lives after spates of bullying online. And that is a key driver of this change. The question is, how do you address those problems without destroying the benefits? And that's the problem here.
And some other confusing things about this. I mean, some platforms this applies to, Facebook, X, TikTok, but others not, such as WhatsApp and messaging platforms. And, it's obvious that these sorts of problems like cyberbullying still take place on places like WhatsApp and messaging platforms. But this is being really closely watched by other countries as well. Could we see similar laws coming into force around the world in the coming months?
Yeah, this is interesting. I mean, if you look at Australia's history, it's got form, hasn't it, with big tech? It's picked fights with big tech before, whether it's X for posting distressing material, whether it's Google or Facebook for not paying local publishers for news. So it's shown a kind of penchant, if you like, for taking on these big companies from the other side of the world, that fights that the rest of the world has looked at before. And the question is, to what extent will this precedent-setting legislation be followed in other countries? Other countries have tried to do similar things with mixed results. To my knowledge, I don't think anyone's ever tried a blanket ban without parental permission for under 16s. There is legislation in other U.S. states, for instance, that allow youth to use it if they have permission from parents. So this is a blunt tool. It's wide-ranging and all-catching. And the question is, will other governments look at the results and say, yeah, this is something we want to do because it's proven to work? Or will they say this is proven to be ineffective? There's just too many youths getting around this legislation, which inevitably there will be some.
Mm-hmm. All right, Angus, thanks very much. That is Bloomberg's Angus Whitley, who has been covering that sweeping social media ban for teenagers under the age of 16 in Australia. I'm Paul Allen, in for Doug Krisner this week. You can catch him weekdays on the Daybreak Asia podcast, looking at the top stories moving markets in the Asia Pacific. It's available on Apple, Spotify, or wherever you get your podcasts. Tom.
Thanks, Paul. And that does it for this edition of Bloomberg Daybreak Weekend. Join us again Monday morning at 5 a.m. Wall Street time for the latest on markets overseas and the news you need to start your day. I'm Tom Busby. Stay with us. Top stories and global business headlines are coming up right now.